Alright, for this video I wanted to do a walkthrough of the Schedule SE for self-employment taxes, and this is going to be for the 2023 tax year. And in this scenario, what we want to do is look at a taxpayer that elects to calculate their self-employment tax under the non-farm optional method. So in this sample Schedule SE and tax return, what we have is the Schedule C business for the taxpayer results in a net loss at the end of the year. So they have a minus $250 loss, and so their Schedule SE for self-employment income works with a minus $250, which ultimately means they owe no self-employment tax, right? So on lines 12 and 13 down here, we have no self-employment tax calculated, and we have no deduction for 1/2 of any kind of self-employment tax because it's zero. So what would we do if instead the taxpayer made the election to calculate their SE income using the non-farm optional method? So that's where we're going to go through here. So I've got the full return for each scenario, so we can flip back and forth and see how it changes. And then lastly, just one slide here covering some background on the SE tax and then more details on the fact pattern. So let's start with just the background on Schedule SE, and then we'll move into the return. So the self-employment taxes, it's a 15.3% rate, and there's two components, right? So we have the Social Security tax, which is 12.4% on your earnings up to $160,200, and this is the ceiling limit for the 2023 tax year. Medicare taxes of 2.9% are assessed on all those earnings, and there's no dollar limit, right? So if you had $2 million of Schedule C income, net income that is, you'd pay 2.9% on the entire lot. Now, the optional methods for calculating self-employment taxes, these deviate from the default method. Now, if you elect to use either of these or both, this will generally result in you paying some higher self-employment taxes than you otherwise would have. And so what we're going to have here is the non-farm optional method. So under this non-farm optional method, the business would calculate their earnings as on the lesser of $6,560 or 2/3 of your gross income. Right. Now, this election under the non-farm method, it can only be used for 5 years. The years don't have to be consecutive, so you can kind of use them sporadically here and there. But what would this look like? So if we have a look at the 1040, Schedule C, so what we're saying is you would use as a self-employed earnings number either $6,560 or 2/3 of your gross income on line 7. Right, and so 2/3 of what we have on line 7 here for this taxpayer would be $43,000 and change. So the lesser of is going to be the $6,560. But you can see how if your gross income from that Schedule C is much, much lower, then maybe you would have a lower amount. But in this case, $6,560 is what we're going to see in our example. Now, why would you ever want to do this? Because if we look at the return for John, where he doesn't make this election, he's not going to owe any self-employment tax. And if we have a look at his tax return here, what we'll see is his taxable income is zero. And so on the tax and credits section, he doesn't owe anything, right? So there's no federal income tax. There's no self-employment taxes here on line 23. So he owes nothing. He owes nothing, and he gets no credits. So why would he want to deviate from that? Well, why he would want to deviate from that is to try to maybe claim the earned income credit or claim deductions for self-employed health insurance, or what's often popular is to increase your Social Security coverage, right? So Social Security, when you want to retire and claim Social Security, the amount of checks that you get, those dollar amounts depend on how much you paid in. So if you are not paying any Social Security tax over the years that you're working, the amount of Social Security payments that you're going to get back are going to be much lower. So let's have a look at John's fact pattern here, and then we'll see what is the impact of him making this election. So if we start with, we'll just go through the non-election one really quickly. So he's got a net loss on his Schedule C, minus $250. So on Schedule SE, the amount of income he's reporting from line 31 of Schedule C is minus $250. And so ultimately down here, he's not paying any taxes because he doesn't have positive amounts of self-employed earnings. So no self-employment tax, but because he has no earned income either, he doesn't get the earned income credit. So what would it look like if he made this non-farm optional election? So if we start with the Schedule C, a couple things to note here. First, the Schedule C doesn't change, right? So we still have this minus $250 of losses. The minus $250 flows through to Schedule 1. It's still $250 of losses, and then that $250 still flows through to page 1 of the 1040 on line 8. So the net amount of income or loss from Schedule C, that remains unchanged whether you make this election or not. What will change is how you calculate your self-employment income. And then now that you have some earned income, or the earned income amount is different, how does that impact things like the earned income credit or the additional child tax credit? So we'll look at the Schedule SE here for the self-employment tax. Now, lines 1A through 4A we can skip because they don't apply to us. Normally, you would be using line 3, right? We would have a Schedule C line 31 amount, and you would go from there. But because we are making this optional method election, we are skipping down to 4B. So line 4B, if we elect to use one or both of these optional methods above, enter the totals of line 15 and line 17 here. So that's down here in part 2. So optional methods to figure our net earnings. The first method that you have to consider is the farm optional method. Well, John is in the consulting business. He's in marketing. He's not doing a farming business. So the maximum amount for the optional method is $6,560. He doesn't have any gross farm income, so we're just entering 0 there. And then on to the non-farm optional method, we subtract line 15 from 14, and we're still left with this $6,560 number. Now on line 17, this is where we would enter the smaller of 2/3 of our gross non-farm income, or the amount above here on line 16. Well, 2/3 of our gross non-farm income, if we go back to Schedule C, our gross income on line 7, $65K. So 2/3 of that is going to be that $43,000 figure. Well, that's much higher than this value. So the lesser of is going to be $6,560. So we take our $6,560, transfer that back up here to line 4B, and then now we can continue on with the return. So line 4C, we combine A and B. We're left with the $6,560. We are not a church employee, and we don't have any other wages that are going to be included. So lines 5A, B, and 8A through 8C are blank for us. Now, the $160,200, that is the Social Security wage cap for the year, for 2023. So that value is placed on line 7. And so on line 10, we multiply the smaller of 6 or line 9 by 12.4%. So that's the Social Security amount. So the smaller of 6 or line 9 is $6,560. So we would take our $6,560 times 12.4%, and we're left with $813. Then we would multiply line 6, so $6,560 times 2.9%, and we're left with $190. So now the total amount of self-employment tax that we owe is $1,003, and then the deduction that we get for 1/2 of our SE tax is half of that, so 50%, $502. So this value is reported on Schedule 2. This value is reported on Schedule 1. So Schedule 2, line 4, we have our self-employment taxes owed of $1,003. And then on Schedule 1, down here in Part 2, we have the deductible part of our SE tax of $502. All right, so now when we look at Form 1040, page 2, we can see now we have an entry on line 23 for the amount of self-employment taxes owed. So before, this was zero. Now we have to pay $1,000 in. Okay? So now that we've calculated how much SE tax we owe, how does that impact the other things like the earned income credit? So now you notice that we have a value entered for earned income credit because now we have some positive earned income. So if we take a quick look at the EIC worksheets, so this is the earned income credit worksheet for self-employed members. So we have the amounts flowing through from Schedule SE Part 1, line 4B and A. There's our $6,560 figure. There is the 1/2 deduction for the self-employment tax, and our net earned income from self-employment is $6,058. So now that we have this $6,058 figure, we can complete the earned income credit worksheet to figure out how much of the EIC amounts we can get. Now, I won't look up the tables here. I've got a lot of EIC worksheet videos going into the detail on the tables, but what we can see at the end of the day here is now that John has some actual earned income, he gets an EIC amount for $465. So we've got $1,003 in tax owed. We have a refundable credit EIC for $465, and so the net amount of tax that John is going to have to pay is $538. So by making this election, he has done, two things, right? So first, now he has to pay something. Before, he owed nothing because his income was low enough. Now he's actually got to pay, but he is paying into Social Security, right? So that's going to help him out when he retires. And then secondly, he is now qualifying for the EIC amounts, so it is going to help reduce that tax burden. Now, it's important for taxpayers to go back and forth on this and see what makes sense, right? So choosing the non-farm optional method if your income is low, might not always be the best idea, right? You really have to kind of look at the numbers, see how it impacts your return, and then you decide what makes best for you from a tax perspective. So that covers it. I hope that was helpful. Any questions, feel free to leave a comment below. And as always, I appreciate you watching, and I look forward to seeing you again on the next videos. Thank you.